Hey guys, welcome back to the Bitcoin Fortress podcast, building one block at a time. Today's Sunday, May 10th, 2026, and we are recording at block height 948805. Moscow time is 1230 sats per dollar, and fees are beautifully boring again at 1, 1, and 2 sats per VByte. This week, Bitcoin is trading around the $80,000 to $82,000 range, and the story is not just price. The deeper story is that Bitcoin is being pulled into every major arena at once: Wall Street products, ETF flows, corporate balance sheets, public pensions, mining infrastructure, banking rails, geopolitics, and regulation. That is what makes this moment so fascinating. Bitcoin is no longer a fringe asset begging for recognition. It is becoming a measuring stick for the financial system itself. And with that, let's jump into the news, starting with market structure, ETFs, and price action. Bitcoin pushed back above $80,000 this week and briefly reached the low 82s, helped by an improving risk sentiment and optimism around US-Iran peace negotiations before slipping back toward 80,000 as traders took profits. The important thing here is that Bitcoin is increasingly trading like a global macro asset. That does not mean it has become just another risk asset, but it does mean that major macro events now show up quickly in Bitcoin's price. When geopolitical fear rises, liquidity tightens, or energy uncertainty increases, Bitcoin can sell off with other risk assets. But when the market senses relief, Bitcoin often responds first and aggressively. That is actually a sign of maturity. Bitcoin is no longer isolated. It is sitting at the intersection of liquidity, sovereign risk, energy markets, and institutional capital. The lesson for Bitcoiners: price volatility is not a refutation of the thesis, it is the market repricing the thesis in real time. Bitcoin ETF flows were strong earlier in the week, with reports of roughly $1 billion plus in weekly inflows, but the streak was interrupted by outflows midweek, including a reported $268 million net outflow on May 7th. This is a great reminder that ETFs cut both ways. They are not magic number go up machines. They create structural access, but they also create visible, liquid, institutional grade flows. That means Bitcoin now has a new kind of transparency. We can see the bid, we can see the outflows, we can see when institutions are accumulating and when they are reducing exposure. But the bigger picture remains bullish. ETFs have turned Bitcoin into a standard portfolio instrument. Advisors, pensions, family offices, corporations, and banks now have rails. The ETFs are not Bitcoin. They are paper claims in the legacy system, but they are also a bridge that allows massive pools of capital to get exposure. Morgan Stanley is preparing to introduce spot crypto trading through E-Trade, initially as a pilot, while its spot Bitcoin fund has reportedly attracted hundreds of millions in assets. This is one of the most important themes of the week. The banks that once laughed at Bitcoin are now building Bitcoin access into their platforms. The key point is not that Morgan Stanley believes in Bitcoin philosophically. It is that customer demand has become impossible to ignore. Legacy finance does not adopt things because they are morally correct. It adopts things when clients demand them, fees are available, competitors are moving, and regulatory risk becomes manageable. And that is exactly where we are now. Bitcoin began as an exit from the banking system. Ironically, the banking system is now trying to package access to the exit. Charles Schwab announced Schwab Crypto, a phased rollout giving retail clients direct access to Bitcoin and Ethereum trading integrated with Schwab's broader platform. This is another major normalization moment. Schwab is not a crypto native company. It is the boring, trusted brokerage brand used by millions of mainstream investors. When Schwab adds Bitcoin trading, it reduces friction for a massive demographic of people who were never going to open a Coinbase account, download a self-custody wallet, or go down the technical rabbit hole first. Of course, direct trading at Schwab is not the same thing as self-custody, but access usually comes first, then education, then conviction, then custody. That is the orange pill funnel. Goldman Sachs filed for a Bitcoin premium income ETF that would not hold Bitcoin directly, but would gain indirect exposure through Bitcoin ETPs and option strategies. This is classic Wall Street. First they ignore Bitcoin, then they attack Bitcoin, then they create products that generate fees from Bitcoin. A Bitcoin income ETF is especially interesting because it shows Wall Street turning Bitcoin into a full product ecosystem. Spot exposure, futures exposure, options income, structured products, custody lending, and advisory. That is good and bad. Good because it expands access, bad because financialization can distract people from the simple truth. Bitcoin's core value is not yield, it is final settlement, scarcity, portability, and self-sovereignty. Wall Street will try to turn Bitcoin into income. Bitcoiners should remember that Bitcoin itself is the asset. Moving right along into corporate Bitcoin treasuries and institutional adoption, we have Strategy reported a $12.54 billion Q1 net loss, largely due to Bitcoin price volatility and accounting effects, while remaining the largest Bitcoin holder with more than 818,000 Bitcoin. This is where traditional accounting and Bitcoin reality collide. A company holding Bitcoin can show massive paper losses during drawdowns, even if its long-term thesis remains intact. The accounting optics can look terrifying to people who do not understand the strategy. But Strategy is not just a software company anymore. It is effectively a leveraged Bitcoin capital markets company. The deeper question is, can Strategy continue managing the volatility, preferred shares, debt structure, and investor expectations through multiple cycles? That is the real story, not whether Bitcoin is volatile. We know it is. The question is whether corporate Bitcoin treasury models are durable in bear markets and drawdowns. MarketWatch reported that Michael Saylor, after years of never sell messaging, suggested Strategy could potentially sell some Bitcoin to fund dividends under certain conditions. This is a spicy one. For Bitcoiners, never sell your Bitcoin is almost a sacred phrase, but corporate finance is different from personal cold storage. Strategy has obligations. It has preferred shareholders, it has debt structures, it has public equity market watching every move. So does this not necessarily mean the thesis is broken? It means Strategy is evolving from pure accumulation into a more complex Bitcoin capital markets machine. But it is also a warning. When you introduce leverage, dividends, preferred shares, and Wall Street expectations, you introduce trade-offs. For the individual Bitcoiner, the lesson may be the opposite. Keep it simple. Stack sats, hold your own keys, avoid unnecessary complexity. The New Jersey State Pension Fund reportedly holds about $16.2 million in Strategy shares, giving it indirect Bitcoin exposure through public equities. This is a quiet but important adoption story. Public pensions are conservative institutions. They move slowly. They are politically sensitive. They do not usually want direct exposure to controversial assets. But they can buy equities, and Strategy gives them a kind of backdoor Bitcoin exposure. This is how adoption often works. First, it is direct believers, then it is companies, then ETFs, then pensions, then model portfolios, then default allocations. At some point, Bitcoin exposure becomes less controversial than having no Bitcoin exposure. Tether reported more than $1 billion in Q1 profit, an $8.23 billion reserve buffer, and Bitcoin holdings above 97,000 Bitcoins. Tether is fascinating because it sits at the intersection of stablecoins, US treasuries, emerging markets, and Bitcoin reserves. Tether earns massive profits from treasury yield, then uses part of those profits to accumulate Bitcoin. In other words, the fiat system's interest payments are helping fund Bitcoin accumulation. That is poetic. But it also shows how stablecoins and Bitcoin are different tools. Stablecoins are dollar rails. Bitcoin is the escape hatch. Stablecoins extend the dollar system. Bitcoin competes with it. Okay, moving right along to regulation and the political fight. A compromise involving Senators Tom Tillis and Angela Alsobrooks helped move the Digital Asset Market Clarity Act forward, especially around stablecoin yield restrictions and customer rewards. This matters because regulatory uncertainty has been one of the largest overhangs for the industry. The Clarity Act is not a Bitcoin bill specifically. It covers broader digital assets, market structure, SEC versus CFTC jurisdiction, stablecoins, exchanges, and investor protection. But Bitcoin benefits from clarity because institutions hate ambiguity. The irony is that Bitcoin does not need Congress to survive. Bitcoin produces blocks either way. But capital allocators, banks, advisors, and public companies need legal clarity to participate at scale. So, Bitcoin's survival is permissionless, but institutional adoption is still shaped by policy. The stablecoin compromise reportedly restricts issuers from offering yield that resembles bank deposits while still allowing certain activity-based rewards. This is really about protecting the banking system. Banks do not want stablecoins to become interest-bearing checking accounts that compete directly with deposits. That would threaten one of the core funding models of traditional banking. So the fight is not just crypto regulation, it is a fight over who gets to create dollar-like instruments, who earns the spread, and who controls the customer relationship. Bitcoiners should care because this shows the difference between Bitcoin and stablecoins. Stablecoins are political. They depend on issuers, reserves, rules, banks, and regulators. Bitcoin is neutral. No issuer, no yield committee, no redemption promise, just 21 million. Moving right along to mining, energy, and the AI pivot. Hut 8 stock jumped after announcing a major AI data center lease deal in Texas, potentially worth billions over time, while continuing its shift towards high-performance computing infrastructure. This is one of the biggest structural changes in mining. Bitcoin miners spent years acquiring land, power contracts, substations, cooling systems, and data center expertise. Now, AI companies desperately need exactly those things. So, miners are asking, why mine Bitcoin with volatile revenue when they can lease power-backed infrastructure to AI customers under long-term contracts? That does not mean Bitcoin mining is dead, but it does mean public miners are increasingly energy infrastructure companies, not pure Bitcoin companies. The Bitcoin network will be fine. Difficulty adjusts, hash rate moves, marginal miners get flushed. But investors need to understand what they own. A Bitcoin miner stock may increasingly be an AI infrastructure stock. Riot disclosed that it sold 3,778 Bitcoin in Q1 for about $289.5 million, while ending the quarter with 15,680 Bitcoin and expanded deployed hash rate. This is another example of miners behaving differently from long-term Bitcoiners. A miner may believe in Bitcoin and still sell Bitcoin to fund operations, infrastructure, debt reduction, or AI expansion. That is not necessarily betrayal. Mining is a brutally competitive business. Energy costs, equipment cycles, halving pressure, and debt obligations all matter. But it does remind us that public miners are not Bitcoin savings accounts. If you want Bitcoin exposure, buy Bitcoin. If you want operating company exposure, buy miners. Those are very different risk profiles. Bitfarms has been moving toward a strategy that reduces or eliminates Bitcoin from the balance sheet while pivoting toward AI data centers. This is the cleanest example of the AI pivot. Some miners are saying the quiet part out loud. AI infrastructure may produce more predictable revenue than Bitcoin mining. That is rational from a corporate finance perspective. But from a Bitcoiner's perspective, it reinforces why Bitcoin itself is cleaner than Bitcoin adjacent equities. Bitcoin has no management team, no pivot, no quarterly earnings pressure, no board deciding to chase the latest hot sector. Bitcoin just keeps producing blocks. Moving right along to banking rails, stablecoins, and tokenization. SoFi launched a business banking platform designed to let companies manage fiat, stablecoins, and crypto-related payment flows in one regulated platform. This is the banking system adapting. Companies increasingly want 24/7 settlement, stablecoin rails, faster payment flows, and crypto-adjacent treasury tools. Traditional banking hours do not match internet-native money. Bitcoiners should see this as another sign that the legacy system is being forced to modernize. But again, there's a distinction. Stablecoins improve dollar movement. Bitcoin changes the nature of money itself. One is faster banking. The other is sovereign money. Coinbase announced layoffs of about 700 employees, or roughly 14% of its workforce, as part of a restructuring focused on AI-powered operations. This is not directly a Bitcoin story, but it is part of the broader environment. AI is reshaping every business model, including crypto exchanges. The firms that survive will likely be leaner, more automated, and more global. For Bitcoiners, this is also a reminder not to confuse companies with protocols. Companies hire, fire, pivot, restructure, chase trends, and respond to shareholders. Bitcoin does none of that. Bitcoin is not a company. That remains one of its greatest strengths. All right, jumping into Bitcoin podcast universe themes of the week. The first one being Bitcoin is becoming institutional plumbing. This week's podcast conversation across shows like Coin Stories, TFTC, Rabbit Hole Recap, and Mainstream Finance Podcast focused heavily on institutional adoption, ETFs, bank access, and Bitcoin's role in a broader financial restructuring. Natalie Brunell's recent Coin Stories news blog highlighted several of the same stories: Strategy, Tether, Morgan Stanley, Goldman, BlackRock, Schwab, and institutional portfolio interest. The theme is clear. Bitcoin is entering the financial plumbing. That does not mean the cypherpunk dream is gone. It means Bitcoin is being adopted by different groups for different reasons. Individuals want savings technology. Corporations want treasury strategy. Banks want products. Governments want reserves. Traders want volatility. Bitcoiners, well, we just want freedom. Bitcoin can serve all of them without changing its rules. Bitcoin is for friends, and Bitcoin is for enemies alike. Theme 2, the treasury company boom is entering a more complex phase. The podcast universe is also wrestling with the strategy model, corporate Bitcoin treasuries, preferred shares, dividends, leverage, and whether public companies can responsibly use Bitcoin as a treasury reserve asset. This is no longer just company buys Bitcoin, stock goes up. Now we are dealing with capital structure, dilution, preferred dividends, debt, accounting treatment, regulatory scrutiny, and investor expectations. That is why the simple Bitcoiner strategy may still be superior for most people. Buy Bitcoin, hold your keys, stay solvent, think long term. Wall Street will create complex machines around Bitcoin, but Bitcoin itself remains beautifully simple. Theme 3, Bitcoin versus crypto is becoming clearer. TFTC covered Bitcoin loyalty rewards, non-cash, non-custodial eCash concepts, Clarity Act discussion, and Bitcoin breaking 80,000. The distinction between Bitcoin and broader crypto continues to matter. Crypto wants apps, tokens, yield, governance, foundations, and regulatory carve-outs. Bitcoin wants sound money, final settlement, self-custody, and freedom. There may be useful tools around Bitcoin: Lightning, Fedimint, Cashew, eCash, BTC Pay, Server, Nostr, and more, but the core remains Bitcoin as neutral money. That is the line that we all need to keep clear in our minds. And finally, theme 4, the macro thesis, is back in focus. What Bitcoin Did recently featured Jeff Ross discussing liquidity, financial stress, and why Bitcoin's recent weakness may be setting up a larger inflection point. Bitcoin does not exist in a vacuum. It exists inside a world of debt, deficits, monetary control, inflation, capital controls, banking fragility, and political incentives. The macro thesis is simple. Governments are trapped, debt is too high, promises are too large, currency debasement is the release valve, Bitcoin is the exit. And that connects perfectly to this week's featured Substack post, Bitcoin versus monetary control. And again, this post fits perfectly with this week's news. We just talked about banks trying to control stablecoin yield, regulators trying to define market structure, public companies trying to manage Bitcoin through capital markets, Wall Street wrapping Bitcoin in ETFs and income products, governments slowly waking up to Bitcoin's strategic importance. And underneath all of that, the core issue, control. Fiat money is programmable by institutions. Bitcoin is programmable by rules. Fiat money can be censored, inflated, frozen, redirected, and surveilled. Bitcoin simply asks, do you have the keys? That is why Bitcoin is not just an investment, it is a peaceful monetary rebellion. Before we wrap, just wanted to mention the 4 Bitcoin Fortress books available. You can check those out, links in the show notes. And very excited about the latest book, The Architecture of Money, that I just released recently. It's especially relevant now because it explains the deeper structure behind today's headlines: fiat incentives, debt, debasement, monetary control, and why Bitcoin offers a different foundation. Well, folks, that's a wrap for episode 215 of the Bitcoin Fortress podcast. This week's big takeaway is that Bitcoin is becoming impossible to ignore. Wall Street is building products around it. Banks are integrating it. Pensions are sneaking exposure to it. Companies are restructuring around it. Regulators are trying to define it. Miners are adapting to new energy economics. And through all of it, Bitcoin keeps doing what Bitcoin does. One block at a time, no CEO, no committee, no bailout, no permission required. Stay humble, stack sats, hold your keys. This is Bitcoin Fortress, building one block at a time. And I will talk to y'all next week. Bye-bye.